Tom Filer is a wealth management consultant in a broad area of investment assets and strategy. He is managing director of Fountain Wealth Associates. He's a registered commodities principal and associated person for Commodities and Securities, Inc., a commodity trading advisor registered with Commodities Future Trading Commission, and a member of the National Futures Association. Tom is a veteran of Wall Street for over 20 years. He unveils how the global financial system can work to the disadvantage of everyday Americans and reveals how to protect investors' assets in today's volatile markets. Tom appeared on CNBC Business News, Reuters Television, CNN Money, and was the focus of a featured article in Money magazine. Co-authored Trading Debt for Wealth, a guide to eliminating household debt and implementing prudent personal finances. Tom Filer, welcome to Global Freedom Report.
Thank you very much.
Thanks for being with us. I know that according to official statistics, we're not really in one, but criteria used to determine such things, in my opinion, is skewed by politicians and therefore inaccurate, to say the least. So my question for you to start off is, based on the practical realities of rampant unemployment, slower or non-existent manufacturing, and a general lack of cash on hand for most people, would you say that America is in the midst of the Second Great Depression?
Well, you raised a good point that, whatever you call it, whether it's a deep recession, whether it's a depression, whatever you want to call it, America should be doing better. As an investment manager, we do a lot of analysis, economic and securities analysis. So, what you're hearing out there in the mainstream media doesn't truly reflect, how bad not only our economy is and how weak it is, but also the global economy as well.
Well, and I know that. You see, they have their way of deciding what a recession or depression is, and based on quarterly figures here and there. But anybody who knows statistics knows that statistics can be massaged. So they tell us we're in an economic recovery. Yet everyone I know is struggling to make ends meet. And I see these figures of rampant layoffs. And, I mean, at what point do we look and say, this really is a depression?
Well, I think, the analysis that we've done would indicate, and I know the term I'm going to use is not a securities analytics term, but we refer to the global economy as a dead man walking. Now, the U.S. economy is not there yet, but as I've listened to you many times, Brent, you and other people are sounding the call that our economy is very close, to collapsing into something that is something that's not existed in our lifetimes or since the founding of our country. But if you take a look at the global economy, you've got, of course, a feature of debt, which really has country after country, and we've handcuffed. Their economy is handcuffed. We, of course, see it in Europe, quite substantially. But many other countries, like the United States, have this problem and this challenge as well. Our debt is much worse, well beyond what is reported out there. And so you've got countries in the globe that are either burdened with debt, or the other types of economies you have are command economies. In other words, economies that are run by small groups of people, whether it be a dictator or some type of communist or socialistic regime. And those economies have never created capitalist economies which serve people. In those command economies, the economies always serve those few people that are in control. And so those command economies, they need I guess it's called Western economies, like Europe, like the United States. You go to Japan, that was a great consumer economy, but that economy has been on the floor for over a decade right now. So the problem that you have with the command economies is that there's no consumers out there to sell their goods to. So between the debt that is burdening the Western economies and the lack of consumers for the command economies, that's why we believe that the global economy is really a dead man walking.
My guest is Tom Filer. He is co-author of Trading Debt for Wealth, a guide to eliminating household debt and implementing prudent personal finances, and as a special offer for Global Freedom Report listeners, if you either call the show or call us off the air, I'll give you that number as well. Either way, okay, call the show, call us off the air. The first 20 calls will get a free copy of Trading Debt for Wealth with absolutely no strings attached to that at all. So if you want to call on the air, okay, it's real simple, 208-935-0642. Toll-free numbers are not working, so you have to use this number, 208-935-0642. If you want to call us off the air at the Global Freedom Report, the number is 512-879-3528. 512-879-3528. Just give us a call and say, hey, I'd like a copy of Trading Debt for Wealth, and we'll send it right out to you. Tom Filer, welcome back to the Global Freedom Report. I want to ask you a trick question. I ask people this, and people in economics this all the time, and nobody's gotten it right yet. So I'm going to give you a shot at this. What country on earth has the highest percentage of millionaires?
Abu Dhabi.
Good
or
guess.
China.
Wrong. The answer is Zimbabwe. Everybody is a millionaire. If you look
there
at
you go. Yeah.
It doesn't necessarily mean
I've got a lot of friends who have bought Iraqi dinars, and they're millionaires if they go to Iraq.
Yeah, well, can you tell us anything about that, the Iraqi dinar thing? It seems like a sound investment because you got to figure sooner or later they have to value the currency against the rest of the world. But nobody's been collecting anything. You shed any light on the Iraqi dinars?
I cannot. We do extensive work in the Middle East, and so we're very familiar with everything that's going on in Iraq and all around there. That type of investment is something you do if you've got some extra funds that you can risk. And it may work out with you handsomely, or it may be something that you pay for your wall.
That's why they call it investment. Chaplain Lindsay Williams, who joins us every month to discuss the Global Elite Agenda, has spoken at length of the critical dangers of impending economic collapses, both in the U.S. and Europe, consequently around the world. He said that the primary warning sign involves something called derivatives, and that you are the expert on this topic. What exactly are derivatives?
Derivatives are different things. So they're a wide variety of financial products. For example, a lot of your audience may be familiar with investing in options or stock options. And so those are derivatives. In other words, it's investing in the contract, which is underlaid by some type of asset. So you're not investing in the asset itself, but you're investing in a representation of that asset, which is usually represented by a contract. So that's a pretty simple derivative. But, what the global financial system has done is they've made some very, very complex derivatives, which they use for interest rate swaps on fixed rate income products. They use them for real estate products, as we saw. Derivatives were one of the main reasons that a lot of the real estate properties crashed. And so derivatives can be very simple and they can be very expensive, very complicated. There's no necessarily public market for derivatives, and so at any given time, you or I don't know what type of derivative contracts are being traded out there.
Now, what threshold are we looking at below which the derivative market will signal an imminent economic collapse? I mean, I'm asking the question right. Is it something, look at a schedule and say, it's gotten below 100, now we're going to crash. Is it that basic?
It's not. It's not, because, and this is the real complicated aspect to derivatives, is that they're so complicated that they're not publicly traded. Most of them, the greatest portion, are not publicly traded, so you can't follow them. And it's more so like you wake up one morning and a company like J.P. Morgan Chase lets us know that they just lost $1 They say $2 billion, more than that, of course, in the derivatives trading. Brent, if I could kind of go back to the beginning of the show and your first question about depression, recession, what we would like your listeners to understand is that what we see out there is that it's not really depression or recession that's occurring out there. What's really occurring is a deconstruction of one economic system, which is the system that has existed up till now, and the reconstruction of another economic system. And a lot of people would understand that as to be the creation of a so-called New World Order, New World Economic Order. And this has been in construction for many, many years. And as I think most people would understand, to create a new system, you have to take down or deconstruct the old system. So in our analysis, as we follow the money, as we follow the economic institutions that are here now and those that are either being created or those that are being changed from one purpose to another, that's what we see out there. And I think that's what listeners and people need to understand. It's more of a deconstruction than a crash.
So, okay, now you obviously are able to follow these. So if there's no market, if there's no big board on derivatives, how can you tell when derivatives are crashing or about to crash? I mean, obviously you've been warning people about this, but how can you do that if there's no big board on derivatives? What are you looking for? What are you watching?
Well, I think what people need to understand what the purpose of derivatives, are, and what they were created to do. And this is a very complicated subject, but derivatives were created decades ago, and they were very strongly protected by the powers that be. And I don't think we have time today, but I could tell a story of how the powers that be preventing derivatives from being regulated.
Well, we have
time. It's hard to
some time. We have some time at this segment and another segment.
Okay. I'll truncate the story a little bit, but this is a story which is public. Anybody can go out on the internet and find the story. But it's a story in which powers that be purposely disallowed the regulation of derivatives. And obviously, for the reason that they wanted derivatives to grow, and after they prohibited the regulation of derivatives expanded 5 to 10-fold, and it invariably created a web across the entire financial system, which basically acts as a straitjacket to be able to that prevents the system from continuing anywhere but to what would be called more of a globalist economic system. This story, and I'll try to make this story short, it goes back to about 1998, and I apologize if a few months here or there, but back in 1998, the Clinton administration appointed a new head to the Commodities Futures Trading Commission. This woman's name was Brooksy Bourne. This was a lawyer who for 20 years had worked with a law firm, and it just so happened that they did derivatives work in the law firm. And one of the mistakes that was made when she was appointed, and she was a friend of Hillary Clinton, Ms. Bourne was considered an interview by the President Clinton to be Attorney General, but he chose somebody else, and so she was appointed to the CFTC. And one of the mistakes I would respectfully say that was made with her appointment was she is somebody who actually knew what she was doing, number one, and number two, she is somebody who actually, has integrity. And so what she said about doing upon being appointed to the CFTC was to have her staff investigate what the impact of derivatives had been, would be going into the future. Now, derivatives had already been around for well over a decade, and it had already shown their destructive nature. Listeners may remember back in the 1970s, I believe, Orange County, California was one of the largest counties to go bankrupt, and it was because of derivatives. And there had been other instances like that leading into 1998 that derivatives had already shown to be very, very financially destructive. So her staff released a report that said, and this is just fascinating, that if derivatives were allowed to grow the way they were growing, that it could literally, according to her staff's report, bring down the entire financial system. And this was her report released in 1998. Well, you can imagine she would want everybody to know about this report. So she published it, and she sent it to some of the big global banks who were using derivatives. She sent it to the Fed, to Mr. Greenspan, Chairman Greenspan at the time. She sent it to the executive office and to the economic advisors of the president. And she reports that she got a very, very quiet reaction. Nobody seemed to really be concerned about it, but she did get a call for a meeting with about 9 or 10 of the most powerful, positioned financial people in the entire world. It would be Secretary Greenspan and the people from the executive of the president and the SEC and, et cetera. So some powerful people financially in the world in this meeting. And they told her in no uncertain terms, we don't want you to send this report out. Now, because she had integrity, she continued to send the report out and she continued to sound the alarm. So what happened next was she was hauled before Congress, and this is all public. Hauled before Congress, and she was told by Congress that that this report could be very damaging, and as many things often are, she was actually accused that if she allowed this report to go out and be publicized, that this report might bring down the entire financial system. And what eventually happened was Congress passed a law which prohibited the CFTC from regulating derivatives. Now, the even more fascinating part of the story is that many people will remember, as I'm sure you do, Brent, the story of a hedge fund called Long-Term Capital. About 4 or 5 months after Mr. Warren and the CFTC was told, that you cannot regulate derivatives, Long-Term Capital went bankrupt. Long-Term Capital was a hedge fund, one of the largest hedge funds in the world. It was really formed by some of the superstars and the geniuses of the 1980s, Wall Street geniuses. And they formed Long-Term Capital, and they created many of these very sophisticated products, including derivatives. And it was their derivatives investing which brought down to bankruptcy or near collapse of the Long-Term Capital. And as a matter of fact, if you do research, the entire financial system, the integrity of it was at stake because Long-Term Capital and the derivatives that they had created and invested in was spread throughout the entire world. Well, what happened was banks got together and they bailed out Long-Term Capital. But what's fascinating is, you would have thought at that point powers that be would have gotten back to Ms. Bourne and the CFTC and said, something, you were right, derivatives are dangerous and we need them regulated. But that's not what happened. Derivatives continued to be unregulated, and then, of course, they spread 5, 6, 10-fold throughout the next decade right through today. So one can only but conclude from this story that the powers that be out there had a purpose for the derivatives, and they wanted the derivatives to expand to the degree all throughout the entire world as they have today.
Is it fair to say derivatives go up or down? Because I was going to say what affects derivatives, moves them up or down, but they're not really stocks. So are up and down terms that even apply to the derivative market?
Sure. In a sense, one use of a derivative would be a contract that might hedge a fixed income product. So, if an institution invests heavily in a fixed income product, let's say a treasury, they of course then put themselves at risk that if the interest rates move up, their treasury holdings and value will move down. And so derivatives, contracts, are created to help to hedge that so that as interest rates move up, the derivatives hedge or protect the principal of, let's say, this fixed income, product treasuries, from going down. The problem is that the derivatives are so sophisticated, and in many cases there are an unknown number of what they call counterparties. Those investors who are providing the funds on the hedging side of the derivative, that you really don't know what the true status or value of that derivative is, and you really don't know what the impact is financially, as the market goes against, let's say, the interest rate that's been hedged. And I apologize to your audience that it's a very technical financial product explanation, but
and I get that. I knew this was going to be a very complicated discussion, and I can't help too much because I don't know a whole lot about this. You have indicated.
Well, if I could suggest, Brent, if I could suggest, you mentioned Chaplain Williams, wonderful man. I'm blessed to know him and to have been invited by him to participate on a DVD that he did back in, I think it was April. And on this DVD, he brings this knowledge in the DVD's format about derivatives. And my partner spends an entire segment going through all of the complicated implications of what derivatives are and how they impact you. So I would encourage all your listeners to get their hands on that Chaplain Williams DVD. I think it's called The Secrets of the Elite Mindset.
Yes, and we have
take some time to explain what we're talking about here.
And we have indeed, asked our listeners to do just that. So thank you for that. Speaking of Lindsey Williams, you have said that derivatives are going to hit a certain point, and that's going to signal crash of the euro, crash of the dollar. Is this accurate? Is this correct? And at what point? How do you determine that? And I mean, if I was to ask you, say, when can we expect this is going to happen? That derivatives are going to hit that critical mass point, if I may use the term.
Well, if I could go back to a concept I mentioned earlier, the concept of deconstructing the current, sovereign economies, and deconstructing those, and then reconstructing or constructing a new world order. Derivatives are serving the purpose to do that. And it's a little bit hard to explain, but derivatives really place a straitjacket on the current global financial system, so that the only way for the system to proceed going forward is to really reconstruct a new system. And so that's really what derivatives, the purpose they're serving right now, is to bring about this new world order and to help to deconstruct the current system into a new global economic system.
We have a question from our chat room, Tom, from 33 Alpha. Is your birth certificate a derivative? And he asked the question because the birth certificate is printed on commercial paper. Theoretically, you are owned by the state as established through the birth certificate. They collateralize your future earnings using the birth certificate. Is the birth certificate considered some form of a derivative?